Okay, this is an example of management report review and analysis, and what I like to call an insights video for a rental store that has about five to 6 million in revenue. All right, so I'm going to walk you through the things that we typically look at and give you an example of what we do as part of our insights service, so that if that's something that you would like to have as part of your package with us, that we can accommodate that for you. So the first thing that we're going to look at is the profit and loss. So these are the reports that you're going to get out of your QuickBooks accounting system. And this is going to tell you all of the information that's in your rental specific software, like Point of Rental or whichever rental industry software you have. So what we typically do is we take that rental industry software and we're going to either sync it into your QuickBooks file, or we're going to do monthly or quarterly journal entries to get that information in here. And then in here is going to be all of the expenses, a more general kind of categorization and things that don't happen in the rental software. So this particular client, we're going to look at the profit and loss first, and we're going to look at 2018. And then in this column, we have the year of 2017. This would be called the prior period. This first column here, we could call the current period. And then we're looking at the change in dollar value and the percent change. So what we do is on a monthly or quarterly basis, once the bookkeeping is done and we've got all the information, and then we send you this video explaining to you what they're saying. Typically, we look at 3 columns. So this one's going to be a little bit different because we're looking at just 2. We're comparing 2 full years, 2018 with 2017. So this particular client, the main revenue number went up by about 566,000. That's a 10% increase in revenue, which is pretty significant for a 1-year period. This client was in a pretty active growth period. The refunds are going to be, various refunds to customers. It's about 9 and 10,000, not a huge change year over year. And then sales of products. So for this particular rental store, they don't sell a lot of items, so it's not a big part of revenue. So even though this is a 500% change, it's only a $10,000 difference on the financial statement. So not something that we're really concerned about. We're most, excited or looking most closely at the revenue and how much it has increased year over year. So then after the revenue, we want to look at costs of goods sold. So what are the costs that we're incurring to generate this revenue? So we have 5.8 million in revenue here, but what are the costs that we had? And costs of goods sold are going to be items that are as direct as possible. So here, let's just look at some of the examples, right? Equipment rental. So if you're renting from any of the other stores or something that you don't necessarily own, this particular client was 135 and 160,000. Freight to bring that equipment in, various permits for setting up the structures and things. So most often this is going to be like tent permits. Supplies, just general supplies that are related to those events and things that you're having. And then truck rental was 240,000. So this particular client likes to rent a lot of their truck fleet instead of owning them. So their cost of goods sold was 575,000 for 2018, and 2017 it was 471,000. So cost of goods sold went up by 105,000. So of this basically 575 more that we made in revenue, we had costs that went up not as fast, but costs that went up as well, right? So that number comes down. So we want to make sure that if our revenue or when our revenue is increasing, that we don't have surprises of cost of goods sold increasing even faster. So in actuality, we don't have, the money that we thought we had. So when those two things are netted together, we still have a $471,000 increase in gross profit. The next biggest thing that we would look at for these rental stores is going to be labor. So we're going to look at that in just a moment. We want to make sure that our increase in labor costs didn't also erode our increase in income. So this particular client is very aggressive with 401k and retirement plan matching, especially particularly for the owner. So they spent $90,000 on that, but that's a tax saving strategy. They brought us in and some other firms to do some accounting and different things. And I think there's a difference in categorization. All right, so let's take a look at advertising. So another thing that we want to make sure is that we're not spending so much in advertising and not having an increase in revenue. So their advertising expenses went up by about $5,000 for the year, but that also could be why we were able to increase revenue by $575,000. Okay, they had bought a business or part of a business, so we do have some amortization things happening there. Auto, just general, like owner auto is $4,000. That is a pretty large increase, but that's also a tax strategy item. So making sure that of the automobile that they're personally driving, that we're writing off as much of it as we can. We've got some business licenses. Okay, so here's our first labor item. We had some more temp labor and casual kind of one-off labor things. So that did increase by about $6,000, so almost double, but it is still a relatively large or small number for this particular financial statement. So $13,000 on temp labor is definitely reasonable. Okay, let's talk about commissions and referral fees. So depending on how your business is set up and the location and how you guys like to work, you may be running into commission and referral fees. But this is another area similar to like the advertising where, you know, we paid $7,000 in fees and maybe we didn't have that in the prior year, but that also helped us to get this $575,000 more in revenue. So we want to look at all of that together and make sure that it makes sense. We've got some computer expenses, might be some software and internet. Okay, here's a big one, right? Credit card processing. So, you know, of the payments that you're getting for your clients, how much is that credit card processing? So theirs was $115,000 for the year, and that went up by about $15,000. Again, we would expect this number to go up when revenue goes up because you're processing more credit cards. So that is in line with what we are expecting. Okay, so depreciation. This here is an interesting item, right? So for most of our rental stores, they are adding so much inventory and we might fully depreciate all of those assets in 1 year. So the year that you buy them, we're going to write everything off. We're going to take it as a deduction on the return, even though you're going to be able to rent that item for the next 5 or 7 years. And so this particular client liked to write off everything that they brought in. So this is going to be a difference too between what your actual income is that the business is making and your net income that's showing for a tax purpose. So we had added about 482,000 of assets in 2017 and 524 in 2018. It was an increase of 42,000 in assets. So it does make it look like in order to get this higher 500,000 in revenue, we did have to bring on some more assets. And this also can be just a changeover of some assets and timing things as well. But we do want to be careful that we're not adding more assets than the net income can withstand and making sure that that's not making all of our profit go away. Okay, so we've got some drug testing, dues and subscriptions, different employee benefits. Okay, here's another one. And this one could almost be considered in the cost of goods sold as well. So it's fuel and vehicle maintenance. So of the trucks that they own or any of them that they lease where they have a repair agreement, it was 101,000 compared with 66,000. So almost double, you know, a good 50% more than what it was in the prior year. So something we also want to be looking at as part of cost of goods sold. And then so this particular client, I believe that they had a rather large increase in staff and things to be able to get to the 5.8 million in revenue. So their liability insurance went from 48,000 to 114,000. So definitely something that we want to keep an eye on and make sure that that's not increasing too fast or unreasonable with some of the revenue and things that we have. Okay, so then we've got our other insurance in a few different categories. So another big one for this particular client is going to be health insurance, 174,000 versus 177,000. So not a huge difference there. Kind of depends on how many employees are taking it. We've got some life insurance. The officer is running the life insurance through the business, so that lets them save some money on taxes as well. Workers' comp was fairly the same, and then interest. So how much interest are we incurring on different items that we're leasing or purchasing on payment plans? That's always something that we want to look at as well. So their interest expense went up by about 10,000, which is a 25,000 or 25% increase. So definitely something that we want to be looking at. Okay, legal and professional, maintenance and repair. So this would be other maintenance of the various items within, the rental items and items if the warehouse needed any sort of repairs. So this is actually a negative. It's a decrease. There could be a couple of reasons for that. We may have categorized things a little bit differently year to year, or they had, some less cost equipment things that needed to be repaired. So that's a large decrease, right? $56,000 decrease and a 29% change. Meals, miscellaneous office expenses, office supplies. So being careful here to make sure that, we're buying the things that we need. Okay, and then for this client, payroll taxes was $254,000 compared with $265,000. That's really going to be a function of how much your labor is, so not something that you can really have as much control over. Different promotional items, so also things related to advertising and getting some deductions. This client has home office reimbursement, another tax planning strategy there. They have storage units of 8,600, so some older items or things being stored. That is a $2,000 increase on a 30% increase. So we want to just be mindful of where our storage costs are. A big thing is if you have any rental items that aren't renting on a frequent basis or just sitting there for extended periods of time, to look at least on an annual basis, clearing out those items so that we're not paying for rent and lease expenses for items that aren't generating any money. And those would be types of reports that you would pull out of your rental software to get that information. Okay, then another expense that this client had was $61,000 more in rental warehouse. So they took on a larger, bigger space. So another thing that we really need to look at for against the increase of cost of goods sold and the revenue. So $61,000 increase to be able to have that rental income. Okay, then this client has a special rule for their fixed assets that anything under $2,500, they can actually just run it directly through as an expense instead of having to create it as a fixed asset and depreciate it over times. So their actual equipment cost that they're writing off for the year is going to be this $187,000 plus the depreciation that we had. So 524 plus 187. So their total costs of equipment for the year are about 711,000. So pretty high there and definitely something that we want to look at. And they almost doubled it, 75% more than what they had in the prior year. So they were definitely in an aggressive buying situation, and that led to higher rental income, but also we've got expenses that go with that. We have some sales tax expense, software, property taxes, taxes on licenses, telephone. Some of these accounts kind of got moved around. So we've got employee travel, officers travel, use tax. So depending on for any items that were purchased across state lines and we didn't have to owe sales tax, we are picking up use tax, utilities, and then wages. Okay, so here's our big wage thing for all of the employees. So our wages went up by $290,000. So that is a pretty large increase. So at the end of the day, when we look at everything, our total expenses aside from cost of goods sold are $5 million and 4.4. So our expenses went up by $624,000, and that gives us operating income of a decrease of $152,000. So we had that great increase of revenue. It looked like it was about 500,000, and then we 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 eroded a lot of that with the expenses. The next section that we want to take a look at is other items on the financial statement. So we've got a little bit of dividend income, some investment gain loss, and sales tax discount. Those aren't huge items. We did have some disposal of assets in the prior year where we had to add back some items, but that also is about 23,000. So not a big item for this particular client. Then we have the officer compensation though. So the owner of the business, this is 100% owned as an S entity. There's officer compensation of 226,000 in 2018 and 333,000 in the prior year, plus health insurance. So this particular business, 244 versus 348. But then let's also take a look. So that's a $100,000 change year over year. But let's also take a look at how that impacts the net income. So even though our revenue went up by about 500,000, we end up with a loss here of 23,000. And then this one has break even net income of 816. So when you're looking at this as the owner and you want to know how much money you made from the business, we call it looking at it in two different buckets. So you're going to look at the bucket for how much your salary was and different benefits. And then you're going to look at the pass-through net income bucket as well. So we've got the 244, but when we subtract the 23,000, that means total compensation going to the owner of about 217,000, and that's what will ultimately be picked up on their tax return. For 2017, it was 349,000. So even though this business was more profitable, the total compensation going to the owner, there was about $100,000, $125,000 difference. Now let's look at another thing. How is our net income look, or how is that impacted after we add back the depreciation? So we're going to take a look at, we've got the two of them, right? We've got this rental equipment for 187 and 107, and then we have the depreciation for 524 and 482. So when we add those numbers back in to these net income figures for 2018, it's 688,000, and for 2017, it's 589,000. Now, if we want to take it another step further, we're going to look at how is that, what's the net income? We call it EBITDA, earnings before interest, taxes, and depreciation. So how does the net income look after we add back? Really, in this scenario, we've only added back the depreciation. So we're going to take those two numbers that we just talked about, 688,000 for 18 and 589 for 2019. And how is that as a percentage of revenue for their total revenue? So here we are at 11% for both years. So it's interesting, even though the numbers change, our earnings after we back out, depreciation and fixed assets added is 11% in both years. So this is a really good example of how you can have revenue increasing and less money going to the shareholder. There's so many things that impact the business and the profitability of the business, and how each item changing year for year is going to make a difference in how profitable the business is and actual net money that's being able to hit the bank account. So I hope that gives you a good idea of things that we look at when we do these insights videos, and an example of what that might be when we do your company and look at your things as well.